to SD stock trading. So what we are trying to do here today is look at the different SPDR ETFs. So today, first we're going to look at the XLK, and in the next videos, we're going to look at the rest of the different sector ETFs, SPDRs, and try to predict based on the technicals where we are headed in the next 6 months with the next 1 year. So let's get to it. So XLK is our technology SPDR. It includes many of this, like for example, Apple, Microsoft, NVDA, Visa, MasterCard, Broadcom, Cisco, then CRM, which is Salesforce. This is Accenture, Texas Instrument, all this. It does not include the communication ETF, which is now, or media ETF, which is conglomerate of like stocks like Google, Meta, Netflix. Those some would say are technology stocks, but the way it works is like those are in the XLC ETF. And also it does not have some of the other companies, for example. Okay, let's say the XLK is this composition, right? So a lot of those folks are coming, a lot of this is coming from the software side, some of them coming from the hardware and the service areas. So now the question is that if this is the good representation of not the entire, but the good segment of the technology stocks, then where we are expecting after, specifically with the bounce today after the CPI report on November 11th, where we think that we are going to be headed to the end of the year by Q1 or Q2 next year, and 1 year or 1.5 years from now. So I have this chart from TradingView, and you can see there's some comments here as well. So let's try to digest it. So we have 3 lines here. We have this very defined COVID low, which is here at 68. We have the pre-COVID high, which was right on 2/18/2020. That was 103. And then we have this all-time high, November 2021, and that is at 178. So if you look at like all the way from this pre-COVID high to the top in November 2021, that is about 49%, $49 or 27.35%, and from that's from the so that's for the 41%, 41.62% or $74. From the all-time high to current value of this light blue, the blue dotted line, that's $130. That's what today, 130.81. That's what today post-market on November 11th, this XLK is, and that's around $49, 49.75 or 27.35% drop from the peak. And now, if you can see this this trend, there are a couple of trend lines. One that started back in 2018. You can actually extend that a little bit further, and you can see if we can try to make another extension. But let's say that this looks like more defined line. So here, this is on the regular, not logarithmic chart. So if you look at the chart here, it is a regular chart, not logarithmic chart. We have a defined trend line, the secular bull trend line. So we started that in 2018 around the December 24. If you recall that there was this huge the sell-off that happened when the Fed started raising interest rate in 2018, and then there was this demand destruction. A lot of companies started giving this earning guidance that they're seeing the demand going down for the Christmas, and then we started seeing this dip, and that's where we started this new bull trend, and this trend line that actually then again revisited just around the COVID, and then again we are headed there. So the best case is that somewhere over here, if you follow the bear trend line that started back in November from the top, and then we revisited that in April, again in August, August high, August 15 high, and then we are headed there again. But in the end, we are going to probably get another correction, 8723. That's what this bear trend line that started today, that started back in November, that's still intact today, that meets this secular trend line, and that's where we're supposed to have a bounce. Now the question is that the bottom? Are we going to bottom here in this 130 range, right? So this is 103 range. So this is the 104, 103.90. Why this was important? Because it's the pre-COVID high, and that was support before. Now it becomes a resistance. That becomes a support again, right? So that's why we are kind of headed. And if we follow the trend line, that's where we are going to be, around 10 months from now. Now, depending on your theory as whether we are going to go for the strong recession or a mild recession, then maybe we will actually continue chugging along this line, and then we again revisit the COVID low. And that is where if that happens, then not until April 2024, that's about 18 months from now, we do see the low. So what is the total travel from the peak to bottom? If that happens, that's 61%. Right now, we are around 27% down. So that's another painfully, in the worst case scenario, another 36% or so, 35%, another leg. And that's not in a next 1 week or 2 weeks or 1 month, but that's for the next 2 years, almost 18 months. That's a worst case scenario. And since then, we actually broke the secular bull trend line. That means just like it happened over here. So if you connect, if you think about what happened in 2018, so we were chugging along this line, right? And so here, this line perfectly meets, let's say almost meets this long-term bull trend. Not so there are two intersection points. One is if you consider 2018 new bull trend, and that includes a COVID low, then we are going to meet this bounce back around July next year. But if you consider the long term, it started around 2008 after the great financial crisis. That trend line, the bull trend line, which has a much shallower slope, then we are somewhere around here. So see that this continuing with this bear trend in the same slope, we're intersecting this bear trend with this long-term bull trend at exactly at the COVID low here in that support line. And that happens somewhere around this point, which is 4/15/2024. So now things are looking pretty good, but things are going to change dramatically. I mean, you see this, this all the layoff news, and you wonder that what will happen next year. And my guess is that just like technology bottomed, or going towards like this really painful time right now, at least in the next in this earning period, same thing is going to happen for the rest of the economy, for the rest of the sectors next quarter and the following quarter. So the Q4 as well as for the Q1 next year, that is April. And at that time, we might see a bounce because the Fed might pause, or Fed might actually start even cutting. But then we are probably going to go something like, geopolitically, or the inflation being sticky, and we're going to see the growth really slowing down, and the earning estimates that really already conservative, but still companies are going to get like pretty bad earnings, right? And for the next 2 or 3 quarters, and then we are going to see another trough just about a year from now, and probably going to go here at 420, 415. And since then, after that, this really the long-term bull train that started in 2018 will be impact. But before that happens, we're going to have another quite a bit of drop. So that's the pain point. So the base case here, just to make sure that to reiterate what I just described here. So base case is that we have a soft landing. In that case of the soft landing, we are going to see just like here, this bubble inflates, and we're going to see another near 14% drop, 15% drop to this support line, and that is going to happen in next year around after the summer. And the worst case is in case we have even hard landing and we do not recover for another 16 to 18 months, then we are going to go revisit this trend line, and with another nearly 20% drop, so 41% drop from peak to trough in the best case, and 61% drop for peak to trough for the super bear case. And that's where the technology sector is headed. It's hard to say right now that which one is more likely. I think we have to be data dependent. I mean, one way, if you look at the employment numbers, I mean, although there is a lot of layoffs happening in the Meta and other sectors, but there is really technology sectors, but really there is unemployment rate is 3.5%, and and there is still enough jobs available. I think around, like, last count was 220,000 monthly job in October, end of October. So so altogether, I think there is a possibility of soft landing. So that's why this is the base case. However, if things change very quickly, then we have a problem. And so we have to be looking at the data, and we have to see in the first quarter, maybe in the second quarter next year, that where exactly we are and whether we're making this case or this case. But the bottom line would be that right now, if you're thinking about buying stock today, for all these companies, Apple, Microsoft, NVDA, etc. Now, individual stocks already have suffered a lot, but you'll keep hearing in a different places that the valuation is still very high, and I think that is probably true. So if you look at like the sector-wise weight, the NVIDIA and Microsoft, NVIDIA is still around 30 times earning, and Microsoft is still around 25, and that's probably going to come back once they miss earning again in the first quarter and the Q4. They're probably going to come back another 20-25%, and that is going to cause the sector to actually revisit this one, and then further down the line maybe more. So don't buy right now. So at least, I mean, you can nibble around here when this sector goes to 130. The XLK is around 130, and you can probably definitely buy with both hands if you have the cash back in around 2024, around $68. So that would be my strategy for XLK.